Well, it makes me more nervous when bankers are talking about that, because that's to some extent self-serving potentially, because the only way JP Morgan or UBS for that matter can grow in M&A is basically by helping out the government. So that's one thing. But then politicians, that's another thing. They have to manage expectations. Inflation and interest rates is a lot about expectations. And we have tight monetary policy since 1 year now, but the lag effects are 1 to 2 years. So, so it just eats through the system, and we will see bank failures, corporate failures, mutual fund failures, etc. But fortunately, this bubble is kind of deflating step by step and not in one big thing, and towards normalizing interest rates, normal conditions, and that's very positive. But you can expect as a consequence, of course, that the companies which have to refinance over time here, they are facing then debt service bills which are 3-4 times higher, and some of them will not make it. And that's the environment the next 6 to 12 months at least. Wow. But overall, it's quite positive. I remember last fall that a Swiss minister was basically recommending people to buy candles because of the impending energy crisis. So pretty normal everything.
That's the cyclical side, but there's also a structural side. I know you've had a ton of meetings in Germany recently gathering some intel. And one of the problems is that we are now seeing this real change in geopolitics to the point where American companies are making decisions to invest in America. You're seeing supply chains re-geared around the geopolitics. What information have you been just gathering, and what's changed in your view around the geopolitics when it comes to investing?
Well, with the war in Ukraine, basically, that was the final nail in the coffin of the fact that we had basically since the end of the Cold War, trade and business and economics topping all security and political concerns. That's over, and you feel it very strongly in Germany. I was in Berlin. And so it's clear, and we see it very prominently between the US and China, obviously, where this is all about the de-risking, we speak, and we are softening a bit. With Russia, it's decoupling, full decoupling. So that's very important. At the same time, the Western economies have aging populations, post-COVID, huge deficits, basically. And they have to basically improve and reform growth and productivity. You know, we have technology playing into it. That's one thing. And then in Europe, a great day today for the ECB because it's an unparalleled success story, the European currency. But you know, there's a lack of banking union and there's a lack of capital market union. You have to raise this investment capital somewhere. And the EU could do it quite easily by creating a big common capital market. That's why the US banking system is structurally performing better than anybody else.
There's a lot in there to obviously unpack, given it's a big day for the ECB 25 years on. But just circling back to the starting point for the central bank, inflation is something they're having to deal with right now. But are we talking about a change in the system thanks to all of these geopolitical events? That means central banks, including the ECB, in its next 25 years are going to have to just deal with higher inflation from here.
Well, post 2008 crisis, of course, we had cheap and zero-cost money. And that has created a lot of misallocation of resources. And now we have to deal with the fallout of that.
So is this a shakeout that resets the equation, or is that still going to be a problem for many years from here?
No, I think it should be a shakeout in the terms of creative destruction. My worry is more that there is not enough shakeout, and then we just, we are just kind of dealing, with structures which are not competitive really. So it's all about finding the right balance between policymakers and the real economy to basically become more competitive again.